All right, good morning, everybody. I had a friend call me this week asking what he should do about selling his house in Portland, Oregon, the Portland, Washington area. And it's a nice house. It's one that they bought just pre-pandemic. And he's wondering, how painful is it going to be for him to sell? He's moved back to the Bay Area. And it's always a tricky question. My first recommendation, of course, is to talk to your local realtor. But in terms of the data, it is really telling about what we want to discuss today. And those are the signals that we can see for 2024 and some of the expectations. We have, excuse me, we know that inventory has been super tight, new sellers have been super tight, but we also know that demand has been down, buyers have been down with affordability, and total transaction volume has been down. We know that home prices haven't really fallen in most markets around the country, maybe just a little bit last year. And so what does that mean for a potential home seller for the first quarter? Well, what I told him was a lot of what we'll talk about today. What we can see are maybe some inklings of some new supply being able to hit the market. More supply means more transactions. We've had a supply constrained market. We can see really direct impact of mortgage rates related to where home buyers and sellers are going to come into the market. And we're going to talk about those today. And we'll talk about any signals we have for home price pressures in 2024. And I'll tie those back into my friend in Oregon to see what we might tell him. Altos Research, of course, tracks every home for sale in the country every week. We track all the pricing, all the supply and demand, all the changes in that data so we can make it available to you before you see it in the traditional channels. What we're doing today is looking at the leading indicators for the 2024 housing market. As always, we'll record this webinar. You can get the recording. Anybody who's registered for the webinar will get the email later today when the recording is available. You can share that around. It'll be available on our YouTube channel. In the chat, we have Lael and Jeff from the Altos team. And as I'm talking, they're there to help try to answer questions on the fly. They will share links. So if I share a link of something to click through to, they will share that link in the chat as well, so you can click through there. So keep your eye on the chat. I always like to hear where people are dialing in from, connecting all over the country. We have a big crowd today. And so let's get started in looking at what we're going to look at. I have some thoughts for 2024. And I'm going to start with really two rules of thumb for how do we expect the 2024 market to go. The first rule you may have heard me say before, and that is to think about where inventory goes. Inventory will increase as rates increase and fall as rates fall. And I'll show you some data on this, but it's counterintuitive to some people. Some people are expecting that once rates fall, then we'll finally have some sellers, and therefore we'll have some inventory, and therefore we will have more transactions. But the data shows that the opposite is true, that the available inventory climbs as rates climb. And it's really a holding cost question. And I'll show you what that means in the future. So in a couple of slides, when people ask you, are we finally going to see some inventory in 2024? The answer is, if rates stay high or go higher from here, we will see inventory build. If rates fall from here, we will see buyer demand pick up, more competition, and less so supply. So actually the inventory will fall. So first rule of thumb for understanding 2024 is, if rates go up, inventory goes up. If rates go down, your actual selection for your buyers is going to decline. Also, you have more buyer competition. So that's important for some buyers who may be waiting on the sidelines to take action until it gets cheaper. Because what's going to happen is while the payments get cheaper, the competition heats up at that same time. So that's the first rule of thumb. The second rule of thumb for 2024 is that consumers are proving to be more sensitive to changes in rates than to the absolute rates themselves. So mortgage rates were 8%. Now they're 7.4, and it actually suddenly looks cheaper for the people who are shopping at 8%. The changes in rates are what people are more sensitive to. In this fall, inventory has been climbing this fall. It's been climbing because mortgage rates climbed, as I mentioned in Rule 1, but they climbed from 6.5 to 8 in a very short period of time. Those changes, the change in rates, were really what was impactful for slowing the market this fall. And if you think about last fall and into last spring, this spring we had surprisingly declining inventory. We had more buyers than sellers, and that was a result of rates going from 7.5 to 6. So the change in rates is what consumers are sensitive to. So when your clients, when buyers and sellers are asking you about what to expect for 2024, when it is notable that if rates go from where they are now, 7.5 to in the 6s, that's likely to spur a surprising amount of demand, even though it's not that much more affordable. It's not back to normal levels of affordability. So those are two rules to keep in mind for 2024, and I'll try to show you how those play out. I'll show you those slides on what happens with inventory and mortgage rates, and then we're going to look at inventory, prices, and transaction volume for the rest, for what we can see for 2024. And when I talk about transaction volume, I mentioned this in one of my weekly videos recently, and the insight is this. It looks to me like we may be right now at the bottom of the housing recession in terms of numbers of home sales. We're starting to have slightly improved sales per week, just barely. We finally got to even, and maybe we're starting to be just barely. The year-over-year comparisons are starting to tick up, and so as long as rates don't, say, jump from here over 8.5, then it looks like if rates stay normal, or rates stay even, then we will probably starting in first quarter start to print slight year-over-year home transaction gains. So the number of sales may be at the very low point right now. It's really early in this data, and consumers are very sensitive to mortgage rates, the changes in rates. And so if rates go down, that improves. If rates go up from here, that forecast of better transaction volume actually goes away. So we are going to spend some time with the local markets. And, as always, I'm going to try to talk about how to communicate this data to buyers and sellers right now. All right. Before I dive into the data, as you're watching these videos, and if you need to communicate to buyers and sellers, I recommend that if you haven't already grabbed it, grab the ebook, the Altos ebook. It's how to use market data in your business. There's a link in the chat right now. I'm sure Lael put it in there. You can click through and download that ebook. There's scripts, there's ideas, there's frames for like, what do I say in different conditions to my buyers and sellers? So grab that ebook. It's really useful for helping you communicate. Okay, let's dive into some data. We're going to start with inventory. Inventory has been rising late in the year, very late in the year. In fact, into November. Now, inventory is basically plateaued for the year, but I got the preliminary data for this week, and it does not look like it's down substantially. Next week is Thanksgiving, so I assume that inventory is going to fall for Thanksgiving for next week. That would be shocking if it didn't, but it's also already kind of a shocking year. And that inventory grew very, very late in the year. And inventory grew late in the year because mortgage rates rose late in the year. So remember, that's that rule of thumb, that the Altos rule that I mentioned at the top of the webinar here. If rates rise, inventory rises. If rates fall, inventory falls. And that's counterintuitive to many people's assumptions. So, but it was true again. It was true last fall. It's true again this fall. It was true the other direction this spring. Inventory fell because rates fell and we had more buyers and sellers. The falling rates spurs demand more than supply. And so the available selection falls. Now, as rates fall, that spurs transaction volume. So even though selection is down, more people are buying things. And so that'll actually improve the number of sales that are happening, but it's going to be tougher for buyers. And the other, so that's the first rule. And the second rule, remember, is that consumers are more sensitive to changes in rates than to the absolute levels. And so what that says is that if rates stay at roughly the same level in the sevens into 2024, that's actually mildly bullish. Unchanged is mildly bullish because consumers are settled into the expectation. It's the change that throws us off and a rapid rise. So you can look at that as mildly bullish in terms of a few more people being able to make offers and get deals done and rising transaction rates. So currently at 567,000 single family homes on the market. That's the same level as last year. It has not fallen. Inventory has not fallen yet in November, though. It's plateaued. So it's basically, rise is basically done, and then, next week would be Thanksgiving and we'll start seeing things start to tick down. Let's look specifically at the last year of mortgage rates and the trend in inventory. So we have here is the line of the last year of mortgage rates. So mortgage rates have been as high as 8%, as low as 6% in the last year. And in the green period here, the green shaded time, we had inventory falling as mortgage rates were generally falling. Inventory fell very late into the year this year because mortgage rates didn't bottom until very late in the year. And so there were more people who were reacting on the change lower, and they were buying homes. Surprisingly, I did not expect this when we were doing this webinar last November. We did not expect inventory to fall for the first half of the year. It was not in the cards at that time. But it was really consumers being sensitive to rates. Then rates rose. They went from 6 all the way up to 8 in the second half of the year. And especially in October, there was that last big spike here at the right end of the chart. And you can see when rates spiked up to 8 in October, that slowed buyers, and therefore inventory is building still in November. Now rates are back off that peak, and as long as they don't spike again, then we can start to assume we're going to resume our normal, more seasonal inventory patterns. So as we look, again, this is just an illustration. As rates are generally falling, inventory is falling. As rates are building, inventory is building. And because consumers are sensitive to changes in rates, when they go from 6.5 to 8, or they go from 7.5 to 8 in a week, then consumers slow really quickly. So you can see both of those rules of thumb for how 2024 is going to shape up. Now, I don't predict mortgage rates. I don't have any capacity to know if rates go to 9 from here, or if they go to 5. I don't have, that's just not in the data, and I don't have any skill. I'm skeptical that anybody has a skill to do it. So rates could go higher from here. They could go above 8. And if they go above 8, you're going to see further deterioration in terms of the number of sales. You're going to see price pressures. You're going to see inventory building. So that absolutely could happen, and we can see how quickly consumers are adjusting to that. On the other hand, they go down or they stay the same. Staying the same is mildly bullish. Going down becomes significantly more bullish, like we saw in the beginning of this year. So therefore, let's do a forecast of inventory for 2024. Each line here is a year, and you can see the seasonal changes in inventory. Inventory usually peaks in August, maybe September. This year it's peaking in November, maybe even peaking Thanksgiving week. But basically it's flat now. Each line is a year. You can see the red lines at the bottom of the last few years. There is the bright red line is last year. There's a dark red line that's this year. And the dotted dark line that's the curve we anticipate for 2024. This would assume a few things, a few big assumptions for understanding inventory. It assumes that rates don't have dramatic changes from here. If they go, like I said, if rates go above 8 and they go above 8 quickly, then this will climb higher. If they go down, especially if they go down below 7 quickly, that change will spur demand and inventory will fall. So we can assume, though, assuming rates stay about the same, some inventory increase for the year. And I say that because higher rates generally yields higher inventory. It's because we have higher holding costs for holding real estate. And so when I go to buy the next house, I need to sell the first one to finance my next purchase. When rates are 3%, I don't have to sell the first one. Now I keep 2. And so inventory has been falling for a decade, and as rates were falling for a decade. Now we're in a higher rate environment, and therefore we will resell more homes when we sell. They pencil out less often for investors. For individual buyers, you don't get to keep the first one when you sell the second one. We buy fewer second homes, those kinds of things that lead to rising inventory when we have higher rates. So in general, we're forecasting higher inventory for 2024. You can see how the dotted line is a little bit higher. There is nothing in the data that indicates a surge of inventory that would get us back to, the 2018, 2019 normal times. Normally this time of year, there might be 1 million homes on the market. Now there's 600,000, 600,000 or 700,000, 600,000 now, under 6. And so there's nothing in the data that shows a surge of inventory. There's no investors unloading. There's no Airbnb owners who are panicking, or they may be panicking, but they're not selling their houses in any bulk. There are only a couple of markets in the country, and I'll show you that in the local data in a minute, where we have more inventory now than in the last decade. Only a tiny handful. There are a few that are starting to normalize. So this curve shows us, the dotted line shows us where we'll be next year, a little bit more, assuming that, it gets a little less affordable and we get a few more resales to build inventory in 2024. So that's the forecast of what we're looking at, we're expecting. The other big assumption here is the economy. Like mortgage rates, I don't forecast recessions. I don't know if a recession is happening. A year ago, when we did this webinar in November of last year, I forecasted that inventory might get as high as 700,000 this year because of higher rates and a slowing economy. But the economy never slowed. That recession that was essentially everybody thought was guaranteed a year ago never got here. And so maybe it hits hard next year. And if it hits hard next year, you could imagine a scenario where fewer buyers, more sellers, and inventory starts to build more. As far as a big surge of inventory from a recession, a big job loss recession, thus with you lose your job, you can't pay your mortgage, you have to sell, distressed homeowners, that's really, even if that's a 12-month lag behind the recession. So even if that big recession starts now, that's really 2025 inventory before we'd see any distressed inventory. And that the latest economy continues to be strong. The data continues to be strong and growing, and job losses are starting to tick up, but people are still very well employed in this country. So there is nothing in the data yet that implies any surge in listings, but with some luck, we'll have a little bigger selection for buyers, which will lead to less of a supply constraint for sales and will actually help us increase the number of transactions in 2024 over 2023. Okay, this is looking at what we call the immediate sales. The immediate sales were the phenomenon that happened during the pandemic. This was house gets listed, it takes offers immediately, goes into contract that afternoon or the next day. And at some points during that pandemic frenzy, that those immediate sales were like a third of the homes were going into contract immediately. It's a crazy, right? Those are bidding wars, all those kind of things. What we can see right now is that in this chart, each bar is the quantity, the number of homes that were listed for sale in a given week. And the light portion of the bar are those new listings that went into contract immediately. So you can see 3 years of data here. And we could see that after July, right in the middle of the chart, after July of last year, the new listings dropped immediately. Anybody who was tried to sell in the first half of the year, second half of the year, they dropped immediately, dropped dramatically late in the year. And so we had both supply constrained and demand constrained on transaction volume. And so when we hear things like the seasonally adjusted home sales number is under 4 million, that's an NAR number that they announce. And when they announce that, it's both a supply and demand equation. It's not just demand being low, although demand has been low. So what we can see now is this week, there's a horizontal dotted line. That's the level from this week, 66,000 new listings this week, with 11,000 of those already in contract. And so what we're watching here is now, because last year was so few, that we can start to see year over year gains. And when we have more gains and as more new listings, we lift some of the supply constraints. As long as the light portion of the bar, the immediate sales, isn't shrinking, then that implies we're going to get more new sales. So like we have more new listings, more people can buy those homes. And so we've had fewer new listings than last year. All year long, we've had less supply, dramatically shortage of supply. So on this chart, in the weekly videos and these webinars each month, what we're going to watch for is slight growth in the new listings volume year over year. And we're going to make sure that if the new listings volume is spiking, like that would be a signal, like I was talking about, that isn't there yet, of maybe investors are selling, or somebody like Airbnb owners are selling, or there's a job loss recession. If we saw that spiking, we're going to know that those are potential. They're not there yet. And we're going to watch to see how many of those are gobbled up quickly. So last year at this time, only 9,000 immediate sales. This year, 11,000 immediate sales. So there is some, it's like if they work in tandem, then that will be a moderately bullish sign for the market. Let's look at those immediate sales as a percentage of new listings. And so, how many of these, when during the pandemic, 25, 30, 35% of the homes that were getting listed were getting bought immediately. That's crazy, crazy hot. And so we can use this percentage to gauge demand. And you can see, if 25% is normal, we can see that on the far right end of the chart here, we're down at like 15% of the homes, 16% of the homes going into contract immediately. I'm watching this percentage to know whether any demand is kicking up at all for after the new year. And my suspicion is, like we can see after January of this year, we could see those immediate sales kicked up back over 25%. And that's when rates dropped. And we had surprising amounts of demand in the first half of the year. In the first half of the year, we were absolutely supply constrained. The number of sales was supply constrained. So then rates rose. You can see the immediate sales ticking back down here. And that's at the far right end of the chart, this decline. So that's what we're going to watch for to know whether new listings volume is going to lead to more transactions. I anticipate that it is, unless we get a rate spike from here, and then it would be the opposite. And if we look at those new listings, here's what I was talking about. The dark line here is the curve for this year. This is how many new listings are each week. The other lines are previous years. And what you can see is that we have fewer new listings every week, all year long. You can see the gray line. That was the first weeks of the pandemic when the new listings dropped way down, but we had record few new listings that were unsold on the market. Right now, though, we are ticking above last year. And so these are inklings to me, maybe first indication that we have maybe closer to normal supply curve starting next year. Slightly more inventory, slightly more transactions. So it's 55,000 new unsold listings this week. We had another 11,000 that are already sold. And so you can see how maybe we're now even or just above the supply from last year. So these are what I'm talking about when I say that we may be at this moment at the bottom of the housing recession. And you can think of housing recession in two buckets. The consumers care about home prices. Are home prices falling? And the industry cares about transaction volume. Are we going to get more sales? Are we going to do more business? Home prices stayed surprisingly firm over the last 18 months. A little bit of downtick. The transaction volume is where we've had the recession. We've had far fewer sellers, far fewer buyers, and therefore far fewer transactions. And so that's what I'm saying when we turn the corner in the recession, is that maybe we're starting to see a little normalization in that as people get used to. We have fewer changes in mortgage rates. People get used to where we are. We start to see a more normalized market. Early inklings there. All right, let's switch to the sales side. These are pendings, the total number of pendings, homes in contract during a given week. So the taller the bar, the more homes that are in contract that are about to be sold. We have slightly fewer total in the pendings column, 300,000 now versus 314,000 last year. And you can use the dotted line to see where things were last year. But this week, we had 52,000 new sales pending. And the same week last year, there was 50,000. So just slight improvements in the number of transactions that are coming. And so these are early and very interest rate sensitive, but that's what I am starting to keep my eyes on for the first quarter and help the whole year go that way. So fingers crossed that implies a little more inventory, a little more selection, a few more transactions to happen. And when we look at just the new pendings each week, so not the total number of sales that are in the bucket, but the new ones that happen each week, the new contracts, you can see the dark red line was this year, all year long, every week, all year long. We've had fewer sales every week than the year prior. Just the last few weeks, you can see we're basically even. It's starting to be about the same. And it looks to me like we are now with the 52,500 new contracts pending this week. This is single family homes. We're ahead of last year, and we might be able to finish the year with finally sales no longer fewer than the year before. Again, so this is why I'm starting to talk about this. Maybe we're at the bottom of the transaction volume, the sales volume recession in housing. Days on market, we could see annual curves during the pandemic, you could see the boom markets, very short time on market that normalized a bit last year. We're back into the normal curves, but still the time on market is still actually shorter than pre-pandemic normal. That's because we have fewer homes on the market. We have the people who are buying are ready to take action more quickly. And so because we're supply constrained, we're still see the good ones go quickly, and that keeps the days on market down for the whole country. It's about a month and a half for the whole country, and about the same as we were last year at this time. Okay, so let's switch into pricing. The median price of single family homes in the US is just under $430,000 right now. That's the dark red line here. That is all the homes on the market around the country. It's higher than it was last year at this time, just above, and it's been about 1 to 3% above last year. Home prices staying about 1 to 3% above last year. The peak of June of each year, you can see how we peaked below. So in the first half of the year, home prices were down just a fraction, but because they fell quickly in July and October last year, home prices are up year over year now. The year-over-year comparisons are actually easy. We didn't get quite back to the peak, but the year-over-year comparisons are much easier. If we look at the bright red line, that's the median price of the new listings. That's the leading indicator for where the market will be in the future, because these are the ones that hit the market today. The sellers and the listing agents in aggregate know exactly where to price the home that's going to sell. Any given home may be over or underpriced, but in aggregate, that they know exactly where to price the home. And so last year at this time, that bright red line was dropping very quickly each week, big drop moves. And as a result, that was telling us that future transaction prices were going to be lower. Those sellers said, wow, there's no bidders at the last house, or we finally moved that last one and it was 18% lower. So we're going to price this new listing lower. So you can see that wisdom of the crowds gets put into the red line very quickly. The two big drops are Thanksgiving and Christmas. So we're going to have both of those still happening this year. And we're going to see where the low point is January 1 before homes kick in for the new year again. So what we're looking on the bright red line here is how deep the January 1 trough is, and how quickly then home prices jump with the new inventory after the first of the year. You can see there's a lot of signal in here, and really the takeaway on home prices right now is that nationally there's no signal of home prices declining like there was last year at this time. And so last year at this time led to, we had a few months of the headlines, home prices falling year over year, but those are really over by mid-year. And now we're showing 1 to 2%, 3% home price gains. And so, there's no signal of home prices dropping further from here, unless we have a really nasty jump in rates. And then I think absolutely affordability will play a factor, and home prices could adjust down very quickly like they did last year. This is looking at just the price of the new listings year over year. And as I said, this is the leading indicator. And so what we can see here is the dark red line is this year, the bright red line is last year. At the end of last year, we could see the new listings compressing really quickly, right? They were dropping towards the previous year. We could see that most of this year, the new listings were priced below the previous year. And now they're priced above the previous year, and they continue to be priced above the previous year. And so that shows us that the future transactions are likely to continue to be show year over year gains. And this is a leading indicator for future sales. So you can say that in the first quarter, that home prices, the headlines are going to report home price gains, and they will, if rates, for example, jump and buyers react, those are going to be several months out in the future. These are much more likely to close much sooner. On the sales side, what we do with the sales side is we watch every home that goes into contract every week and where is that priced, and all the homes that are pending, where are they priced? And what those show us here is the dark is the newly pendings each week. And so these correct down, and you can see June and September last year, the big drops in the middle of the chart of the dark line. That was people going, whoa, mortgage rates jumped. This year we had a peak in July. Mortgage rates jumped and home prices, sales prices ratcheted down. We had another jump in October. You can see another ratchet down of prices, but still higher than last year at this time. So again, you look at the dotted line across, and then you can see how low the new transactions were happening, where buyers were buying last year at this time. So each week now prices are above last year at this time. And you can see here how quickly those pending sales are sensitive to rate changes, because it happens exactly when the rates jump. They are sensitive to changes in rates as opposed to the absolute levels. So, if they go from 7.5 now to 8.5, that's going to be a big dip. If they go from 7.5 to 6.5, that's going to help these pending sales numbers. And even though 6.5 is still relatively high to what compared to the last decade. So that's what we're looking at on the sales side. As of right now, the indication is for roughly flat home prices for 2024. There's no indication of any a big dip in home prices. There's none of that in the data. There's, of course, no indication of any surge in home prices, because we still have the affordability challenges. So really what we're looking at is, if rates fall from here, that would be a catalyst to tighter inventory, greater demand, more transactions, and upward pressure on home prices. And then let's look at the last leading indicator, and then we're going to dive into the local data. The last leading indicator that I like to pay attention to are the percentage of homes on the market with price reductions. The price reductions are currently at 39.2%. They've peaked for the year, and they'll start declining. Each line here is a year. The bright red line is last year. And last year we had the real steep climb, because rates were climbing quickly. So the changes in rates that consumers were sensitive to. And we had another jump starting in September. And you can see both last year and this year, we had rate spikes in September, and in both times, price reductions climbed accordingly. We have fewer price reductions now than last year at this time. It's still pretty high. It shows us weak market. It's not hot demand, but it shifted. Really, it shifted after the September rate spike this year, and so we can then assume that homes, if they haven't had an offer now, they get withdrawn over the holidays. The percentage of homes with price reductions falls over the holidays reliably each year. And then in the spring, we get fresh inventory. And so they don't have price reductions until they sit around too long. And so in the spring of this year, we have this normal range. About a third of homes take a price cut before they sell. When the market's cooling, it's going above that. When the market's hot, price reductions are fewer than 30%. And so what I anticipate is, if rates stay in the 7s, we will see the normal curve back down into the normal range. That'll again reinforce an assumption of basically flat year-over-year home prices. But again, if they jump, let's say mortgage rates jump to 9, then you're going to watch another curve up in price reductions as soon as, and it's pretty much to the day that mortgage rates jump, because that week those sellers didn't get the offers they were expecting. Some of them cut their price, and so it really quickly adjusts to buyer demand, watching the price reductions number. All right, let's switch here to some local data. Now I'm going to switch to the Altos product. In the Altos product, this is where our reports, this one's set up for me for our national account, but I can see that I have 11,000 people reading my reports this week. I have the contacts are who they are. I've got 158 new people on my reports this week. I've got, we sent 24,000 opens on those emails. We can see exactly who is opening our campaign, our email campaigns. That's how the Altos product works. And if you want to see the Altos product, and if you need to communicate your local data to your buyers and sellers, I recommend that you go to book a free consult with our team. We'll walk you through how we do this, how you get the data into the hands of your clients. There's a link in the chat. I'm sure Lael or Jeff will put a link in the chat to how to communicate, to join Altos now so you can get the data, get it to your database, get the reports to them every week, help them see these changes in real time. I have a ranking here on the advanced analytics page of my dashboard here, and I'm ranking every large market in the country by price reductions. So normally 35% is a rule of thumb. 35% of the homes take price cut. So we can see Indianapolis and Austin and Denver, Tampa, these guys are all over 50%. Those are slowing markets. Those have negative price implications. Over half of the market has taken a price cut. Like there's no offers happening right now. And so those are negative, bearish on home prices assumptions for the coming handful of months. Austin has been leading the country in price reductions. Indianapolis is slowing faster right now, so that's notable in the last couple of weeks. I've got some Austin data because I've been describing Austin as probably the weakest housing market in the country. But last year at this time, we could see Denver, you could see the home prices climbing, price reductions climbing. 60% of the market had price cuts. Right now it's 50%. You could see in Austin last year, 61, 62%. Right now it's 53%. So in none of these cases is it as abrupt as it was last year. Sellers are much more prepared than they were last year, but you can still see weakness here. And you can still see absolutely the market responded for the last few months. Mortgage rates went from 6.5 to 8. And this is what happened to buyers and to sellers, because the sellers were saying there's no buyers, I got to cut my prices. I'm going to show you Dallas here in a minute too, but I've got a Dallas chart up here where I've charted in my advanced analytics dashboard. I've got Dallas inventory now versus before the pandemic. Are we getting back to normal? And what we can see here is here's 2023. We've been dramatically fewer homes on the market now than pre-pandemic, but Dallas looks to me we can see with rates in the 7s why in 2024 you could see how Dallas might get back to normal levels of inventory. And we can see in the last few months inventory rising, and maybe hasn't even peaked yet for the year in Dallas, probably peaked, but hasn't started falling when normally, inventory would peak in August and start declining dramatically now. So that's a reaction to those mortgage rates. So, I could see when we did early in the thing, we did our forecast of inventory for the year. And I'm showing it increasing for the year, not getting back to normal nationally, but you can see markets like Dallas where with these higher rates, there's more resale that has to happen. There's less affordability. There more gets back into the resale inventory. And so the active inventory starts to climb. That adds selection for buyers. That decreases competition for buyers, though we don't yet see, it's not a lot, it's not a surge, and so there's no corresponding decrease in prices in the data, except maybe in Austin. So let's look at some local market reports here. This is Austin. These are the Altos reports. These are branded for Altos, but of course, when you ship them out to your clients, they're branded for you. And Austin is maybe one of the weakest markets in the country. If I look at our median price, Austin had the massive swing in prices during the pandemic, big immigration, big booming times. But now home prices are basically they're way off the peak, and the peak in May of this year, didn't get close to the peak of the previous year. And we are sort of down year over year in prices in Austin. I don't see prices tanking in Austin from here. Like last year, we were on a really steep downtrend and still in the process. Now we are much slower, but the year over year comparisons are not they're not great in Austin. In fact, I think it's a couple percent of homeowners in Austin who are underwater now. It's the highest in the country, and it is, and it's because of this. If you bought in here, you're probably underwater. You're locked into a nice 3% mortgage rate, so you're not panicked to sell, but you're probably underwater. So 2% of the homes in Austin are underwater. Contrast that to the great financial crisis when there was about 30% of the homes in the country were underwater. 30%. Austin right now is the most in the country at just 2%. Let's look at Dallas, though. Dallas is the one I had that inventory chart for you where it looks like we might get back to normal levels of inventory. This is inventory over 5 years with Dallas. You can see that normally this time of year, inventory is dropping. Here, inventory is still rising. So that says to me, we have weak demand. We don't have a ton of new sellers, but that's starting to normalize. So it looks like we could have some greater supply and therefore greater transaction volume in Dallas in the next year. But if I look at pricing, not nearly as flat as Austin. So the Dallas pricing did not adjust down as much as Austin. In fact, is up year over year a fraction. So slightly fewer people who are, bought in this peak who are underwater. And anybody who bought in the last few years has still got lots of equity in Dallas. So that's a really fascinating contrast. Austin had more, I think, direct California immigration, which stopped cold. And so some of those really top high-end buyer stopped happening, and therefore Austin corrected down. I saw some talk about LA and the Southern California markets. So LA is also building inventory this late in the year. And let's look at inventory this is LA. This is the whole metro area for LA here. So we can see that normally for the dots here are at this point in the year, each year. And we can see that normally we're past the peak, well past the peak of inventory, happens in June each year. And right now it's November and its inventory is still climbing in LA. That's really surprising. It's a function of those mortgage rates jumping in October. And you can in fact see right here, September and October, this moment was inventory had started ticking down, but then rates did that September, October spike and inventory started spiking. Again, this is just illustrates the rule, which is higher rates equals higher inventory, lower rates equals lower inventory. But if we look at price reductions, the leading indicator, we can see last year at this time, 40% of the market had price cuts, and which is kind of high for LA. This year it's in the 20s, which is much more normal for LA. Not bullish, but still on the peak. And normally price reductions is starting to peak by now. My guess is that they peak and start dipping back down. So what this shows us is that in Los Angeles, we have significantly weaker conditions, not as bad as last fall, and starting to get more inventory, which again is the message about we're probably at the low point of the housing recession in terms of number of transactions. If we look in the price ranges in LA, though, very telling. The $5 million stuff takes a long time to sell. Anything under $1 million or less is moving pretty quickly, 28 days. So if you've got buyers and they're saying, hey, I know the market's slowing down, I'm going to buy $1 million house. You say, you know what, if you want to buy $1 million house, if you want to buy that house, that's the highest demand part of the market. And you need to make an offer right away because those are going quickly in 28 days. You think everything's on the market for months, but that's not true. Let's contrast that with Philadelphia. So much of the central and the Northeast are still at pandemic lows for inventory. So look at Philadelphia is still at record few homes for sale for this time of year. And so this is inventory, normally 18,000 homes, and there's 6,300, 6,400 right now in Philly. We can see if we look at the price reductions in Philly, so we can see that more sort of normal range for price reductions, meaning this is a balanced market for Philly. There's buyers and sellers are fewer right now, but there is no sign in Philly of any surge of inventory. And even if there's a surge of inventory, this needs to like triple the number of homes before you start getting into a lot. I'm going to hit Atlanta, and then we will wrap it up for the day. In the Atlanta metro, Atlanta was a big boom market during the pandemic. We have a lot of investor activity. We have a lot of folks who buy in this price range just under just under $400,000. And we can see that that's indeed where the demand is in Atlanta. Notice though, Atlanta is a much more balanced market than Los Angeles, and it's slower at the low price points, and the high price points in Atlanta is like 900,000. Definitely slower, but not like the 5 million range in LA. Much more balanced market, both at the high and the low end. Price reductions in Atlanta are at 36%. Compare that to those Western US markets, which are over 50% of price cuts. So much more balanced in Atlanta. Again, in Atlanta, there's no sign of big price collapse. And if we look at the inventory in Atlanta, we see that fewer homes on the market than last year at this time. So Atlanta it's a high demand market. And so even in a low demand world, Atlanta is a much more balanced than the Western US markets. All right, that's all the time I have for today for the local markets. As I mentioned, as I've been talking about these things, we talk about how to talk about the data in this ebook. If you need to understand, if you need to be able to follow some of the things I am talking about, go grab this. Click, there's a link in the chat now. Go click through, grab it. You can go download that and make sure you use that in your business. And as always, I showed some of the Altos product, but we don't get a lot of time to actually show you how you use the business, use the product, use the data to reach your customers, to reach new folks, to help other folks who are sitting on the sidelines. There are folks on the sidelines right now who are waiting for mortgage rates to drop because they think that's going to give them selection next year, and they're going to be really surprised. They're going to be really surprised when their selection is tighter next year if rates drop. So while affordability would be nice, the lower rates is going to yield lower inventory and greater buyer competition, and it's going to put upward pressure on home prices. So you can talk about that with your clients. Click through to Altos Research, book a demo with our team. Make sure you get the data into your clients' hands today, because the market is so nuts and everybody needs you to be the expert for it. All right, everybody, that's all the time we got for this week. Thank you so much. As always, I really appreciate you being with us. We'll talk again soon.